We continue where we left in this second video. We look at non-current assets to be abandoned. Non-current assets or disposal groups to be abandoned are not classified as held for sale. Why? Because their carrying amount will be recovered principally through continuing use. Is that clear? Okay. We also have a discontinued operation. We've been looking at non-current assets which are being discontinued, but we also have a discontinued operation. A discontinued operation is a component of an entity that either has been disposed of or is classified as held for sale, and A represents a separate major line of business or geographical area of operation, or B is part of a single coordinated plan to dispose of a separate major line of business or geographical area of operation, or C is a subsidiary acquired exclusively with a view to resell. You need to know these definitions of discontinued operations. So a discontinued operation is defined by IFRS 5 as a component of an entity that has operations and cash flows that can be clearly distinguished operationally and for financial reporting purposes from the rest of the entity. The presentation and disclosure of discontinued operation is as follows. You disclose on the face of the statement of profit or loss and other comprehensive income a single line comprising the total of the post-tax profit or loss of discontinued operations and the post-tax gains or losses recognized on the remeasurement to fair value less cost to sell, or on the disposal of assets, disposal groups comprising the discontinued operations. So these you disclose on the face of the statement of profit or loss and other comprehensive income. Then on the face of the statement of profit or loss and other comprehensive income, or in the notes. So what follows, you can either disclose on the face of the statement of profit or loss, or you can disclose in the notes, whichever. The first one, the revenues, expenses, and pre-tax profit or loss of discontinued operations and the related income tax expense. The second one, the gain or loss recognized on the remeasurement to fair value less cost to sell, or on the disposal of assets, disposal groups comprising the discontinued operations and related income tax expense. And thirdly, the net cash flows attributable to the operating, investing, and financing activities of the discontinued operations. So these ones you can either disclose on the face of the statement of profit or loss and other comprehensive income, or you can disclose in the notes. The non-current assets held for sale or disposal groups held for sale, or which have been sold, you also disclose these ones in the notes. What do you disclose in the notes? In the notes, you disclose a description of the non-current assets or disposal group. You disclose a description of the facts and circumstances of the sale or leading to the expected disposal and the expected manner and timing of the disposal. Thirdly, you disclose the gains or losses recognized on assets classified as held for sale, and if not separately disclosed on the face of the statement of profit or loss and other comprehensive income, you disclose the caption which includes these gains or losses. Fourthly, if applicable, the operating segment in which the non-current assets is presented in accordance with IFRS 8 operating segments. Remember we did operating segments last week. So if the operating segment has met the definition of IFRS 5, it's being disposed of, you are going to disclose in the notes the operating segment in which the non-current assets is presented. Finally, you have a pro forma there of the statement of profit or loss and other comprehensive income for XY group, which is indicative of the continuing operations. That's the P&L. So you've got your revenue, your cost of sales, etc., all the way up to profit for the year from continuing operations. Then below that, you bring in your discontinued operations. So you bring in a line item there, profit for the year from discontinued operations, before you total that with the profit from continuing operations to give you the profit for the year. So that brings us to the end of our session on IFRS 5, non-current assets held for sale. We'll move into a question in the revision kit so that we put this into practice. So the question that we are going to practice, it's a past ACCA exam question which came in June 2014. This came in section B of the exam. It's got A, B, C, and D. Our concern for this topic is 28D. M, could you read for us 28D?
On 1st June 20X1, Minco acquired the property for $5 million and annual depreciation of $500,000 is charged on a straight line basis with no residual value. At the end of the previous financial year of 31st May 20X3, when accumulated depreciation was $1 million, a further amount relating to an impairment loss of $350,000 was recognized, which resulted in the property being valued at its estimated value in use. On 1st October 20X3, as a consequence of a proposed move to new premises, the property was classified as held for sale. At the time of classification as held for sale, the fair value less cost to sell was $3.4 million. At the date of the published interim financial statements, 1st December 20X3, the property market had improved and the fair value less cost to sell was reassessed at $3.52 million. And at the year end of 31st May 20X4, it had improved even further. So the fair value less cost to sell was $3.95 million. The property was sold on 5th June 20X4 for $4 million. Discuss how the above items should be dealt with in the financial statements of Minco. Hi, Mr. Crispin.
So discuss how the above should be dealt with in the financial statements of Minco. Now, some questions you have to prove the conditions that yes, this qualifies to be reclassified under IFRS 5. So in such questions, look out for the conditions, those 2 conditions plus the 5 sub-conditions. In some questions, you'll be told straight away that this has qualified and they'll be testing you on the calculations on reclassification. So this is one area where we do not need to prove that the conditions have been met, but just be aware that it can come in those variations. So we have a standard in there. Again, no single question at this level will involve just one standard. Once in a while, yes, but most questions, they will involve at least 2 or 3 standards. So please, even when you've identified one dominant standard, do not close the fact that there could be another standard which is included. You have to try and identify as many standards in a question as you can. So in this one, we have IS 34, interim financial reporting. So I'll explain according to IS 34, interim financial reporting. This standard requires that an entity must apply the same accounting policies in its interim financial statements as it would in its annual financial statements. That is, the measurements should be made on a year-to-date basis. We note that in this question, MINCO's interim financial statements are for the 6 months to November 30 November 2013. So you should have explained that. Then you move to the dominant standard. We have already been told that the sale has qualified, met the conditions, so we just need to apply the standard.
Sorry, Mr. Crispin, you said the interim period is what?
30th November 20x3. 6 months to 30 November 20x3.
Okay.
What's our reporting date according to the question? What's our reporting date?
Says first. 30th November 20x3. But our reporting, we have again a 31st May 20x4. Hello?
I'm looking for the dates. Our reporting date is May 20x4. But the interim reports were
31st November.
30th November. So how many months are those?
30th November. 6.
6 months from July. So July, August, September, October, November.
June.
Or June. June, July, August, September, October, November, 6 months. So we're saying we apply the standard to the question. So we'll continue with the question in the last video.